Are you on the best interest rate? Do you actually even know how to find it? Whether you've got one property or 10 properties, even 0.5% can save you thousands on your mortgage repayments. But some rates offered by lenders aren't what they first appear. To help us find three of the best options in the country, we've got investor, author, and director of Know How Property Finance, Bushy Martin. With decades of experience and over $700 million in loans written, Bushy knows a thing or two about finding the right rate for investors. So let's chat with him right now.
This is a great question, Todd, and one that can save investors thousands, actually, if and only if they get the right information. Because to really put some perspective around this, what's the one thing that most people focus on when getting a home or investment loan, Todd?
Most of the time, it's interest rate. What's the lowest one?
Absolutely. But as we're about to talk about now, rate chasing is actually one of the biggest mistakes that I'd see investors and property buyers and homeowners make, in fact, because low rate loans generally come what I like to call shag you later loans.
Okay.
Because they actually end up costing you potentially hundreds of thousands of dollars more long term.
Mate, and this is exactly why I wanted to get you on, Bushy, because whilst everyone wants the lowest rate, you still got to compare that, or not compare that, pigeon pair that rather, with a lender that's actually going to help you grow your portfolio, which I'm assuming this is more the list that you put together today, correct?
Absolutely. I
Awesome.
want to sort of set a bit of a framework to help people look at loans from the right context in terms of what's important to them rather than what's important to the bank.
Perfect, man. All right, where do you want to start?
I like to keep things simple, and I'm a shock for acronyms, Todd. So rather than rate, I want people to start focusing on what I call the 3 R's, and they are reach, result, and risk.
Reach,
Now,
result, risk. Okay.
Yeah, so if we break that down, reach is about your buying capacity. And would you believe there's a 55% variation across the banks in terms of how much they'll let you borrow based on exactly the same situation?
That is massive.
It is massive. And in simple terms, Todd, just to give you a hard example, that's the difference between securing a $500,000 property and a $750,000 property. And if you hold that property for 20 years, there's an extra $1 million in your back pocket.
Well, if you're looking at that over a property that's huge, if you're looking at that over a portfolio, it starts getting gigantic.
Absolutely massive. So that covers reach. And I think reach is actually your biggest asset as an investor.
Okay.
So that's the first R. The second one is result. And that is, what I mean by result is the total cost of the loan versus the rate. And there's a massive difference between the two, because when you input ingoing, ongoing, outgoing fees and the potential impact of offset accounts into the mix, that can have a massive impact on the actual cost of the loan. So we'll run through the true impacts of those when we compare the loan example shortly. So that's number 2.
Yep.
And then the third component is risk. And that's about loan structuring to make sure that you're protecting yourself while you're optimizing the capacity and minimizing the cost. So they're really the 3 key things. So you need to optimize your capacity, minimize your cost, and minimize your risk, and make sure you do that through clever loan structuring as well as the loan product that you're actually supporting. So,
if I could just quickly jump in, first quick question that comes to mind is if someone's like, oh, all right, I'm with you, I got it, but I can only get 2 of them. Like, like the good, fast, and cheap. You want all 3, but you can only ever get 2. Which one would you say is like the most important that you just do not want to live without as an investor?
As an investor, it's reach every time, followed by the result. So it's maximum capacity, minimum cost, and cost is very different to rate.
Gotcha. Okay.
Now, I guess the next thing that we need to take into account here, because in reality now, Todd, there's more combinations and options in lending than there are combinations on a Rubik's Cube. There are literally thousands, and they change every day. So our lender policies, there's over 40 different banks and lenders and over 2,000 different loan solutions out there, Todd, and they're not static. What I talk to you about today will be different next week. So it's really important to be talking to someone who's really got their finger on the pulse in that arena, so that you're using that frame that we spoke about to take advantage of it. And the other really important thing that's crept in recent times is that banks now rate for risk. Now, what I mean by rate for risk is that the lower the risk to the bank, the lower the rate and the more features and the lower the cost. Now, the things that they rate that risk against are the type of loan, So an owner-occupier loan will be cheaper than an investor loan from the rate perspective, and it's generally about 0.5% or thereabouts.
Yep.
The type of rate is also important. So the difference between a principal and interest loan and an interest-only loan is also important, and we've seen between 0.2 and 0.4% variations in that component. But also, increasingly in recent times, there's been massive discounting around the loan-to-valuation ratio, or LVR, as it's called in the industry. So, an average 80% loan will be about 0.05% more expensive than a 70% loan, and 0.05% less expensive than a 60% loan. If you go over 80% into lender's mortgage insurance territory, then you can be paying up to an extra 0.6% on that overall loan.
So if someone's sitting on a portfolio now that, like, let's say that they bought a few years ago, it was like, I don't know, 75-25, like reasonable LVR. They've got a whole ton of equity in it, and they're now sitting on a 50-50 LVR. They would actually be better off refinancing just for the rate side of things.
100%. The banks have really done a big shift towards LVR pricing. So if someone hasn't looked at their loans for 2 years, they ought to be talking to a savvy broker right now.
Absolutely.
They'll be putting a lot of extra dollars in their pocket.
Yeah.
So that's the key. The amount of the loan is also important. So they come in brackets between 250, 500, 750 generally. But also, here's a trap for many players. If you've got all your lines with one bank, then you're seen as high risk because they've got a lot more money with you. If you're borrowing any more than $2 million with one lender, you're making a big mistake. I'd be splitting it up across a number of banks so that each property has a different lender against it.
Yeah, I've been told that by a lot of more higher net worth friends, that as soon as you start getting into like the 15, 20 million portfolio range, things change. But let's face it, that's a very small fraction of the country. As far as like most mum and dad investors and just anyone really making a go of it, that sounds like very solid advice there.
Yeah, spot on. So they're the key things that you need to keep in mind when you're assessing this exercise. So why don't we now sort of jump into a couple of examples, and then we can talk that through in the context of the 3 R's that we spoke about.
Perfect. What's lender number one? So
lender number one is Connective Select. They have currently got a variable rate at 6.13%. And if we now look at that in the context of cost and the reach that I spoke about, that particular lender will let you borrow about 650 odd grand max based on a pretty typical scenario. And I'll come back to what that means in terms of cost, because you'll be very surprised at this. So that's at 6.13. The second one is Bank of Queensland. Now, the Bank of Queensland, they're offering a 2-year intro fixed rate at 5.79%, but then reverts to 6.24. But they'll let you borrow a little bit extra at 656. And then the third one, the cheapest rate, is 6.09% with FirstMac, who are really investor specialists. So
as much as that's higher than the one that was in the fives, that's not an intro rate, that's a flat rate.
Yeah. So they give you that for 5 years, and then there's a reversion rate. But if you're a smart investor, you'll be refinancing before the end of the 5 years anyway, Todd. But here's the real crux of this, because most people go, oh, great, let's just jump on the 6.09%. Now, the issue there is once you add in ingoing, ongoing, outgoing fees and the impact of offset accounts over the duration of the loan, the FirstMac loan is actually $110,000 more expensive than the Connective Select loan, which has the highest rate.
That's insane. So how long, you're talking about a lifetime, like over 30 years?
That's over the life of the loan. Yes, it would be. So, we're talking a 30-year loan term in that. But sadly, a lot of lenders, because of the headache and the handcuffs of moving from one lender to the next, they'll go with the bank, and then they know it's a good idea to shift, but they don't. And they end up stuck there, and that's where they're likely to end up. So that's really key. But the other interesting thing here, if we come back to what we spoke about initially, and that is the reach, so maximising your borrowing capacity. Yeah. FirstMac, which has a 6.09% rate, they will also give you $760,000 maximum lending versus the $650,000 that you would get with Connective Select.
So it's an extra $110,000 in borrowing power. And just out of interest, because obviously that's going to change wildly depending on people's circumstances. And as we always say, this is not financial advice. Please seek independent professional financial advice because circumstances are different. What are the rough sort of circumstances? Is that off someone with like, what, 100 grand income, 200 grand income?
So this is, that's a very good question. So we're talking about a household income of 160 grand,
Yep.
2 kids, a 10 grand credit card. So a fairly typical type scenario on that basis, and with a typical home loan sitting in behind that. So that it does vary tremendously around the country, but based on those scenarios, that's roughly the sort of capacity that we're talking about.
Excellent. Bushy, is there any other final words of wisdom that you got with this one, mate? Because I feel like this is already going to open up a lot of people's eyes into, but I've seen it for 5.5% elsewhere. And it's like, yeah, but wait a second, look behind, look at the reach, look at the 3 R's to make sure that you're not going to actually stifle your long-term growth as an investor. Is there any other final words of wisdom you really want to leave with everyone today, mate?
Yeah, probably the final thing is just don't pay the loyalty tax by staying with a lender too long. Make sure that you're revisiting your loans every 2 years at the outside, because as I mentioned earlier, it's such a dynamic space. The lending space is extremely competitive, and they're making changes to policies, offerings, rates, cost, fees every day of the week. So make sure that a savvy mortgage broker is a very important part of your team, because as I've said many times, property is a game of finance, and if you've got the right players sitting in your pocket, then you can really optimise the way your portfolio grows.
Bushy Martin from Know How Property Finance, thank you so much for jumping on the show, mate. Always appreciate your time.
Thanks, Todd.